When it comes to investing, mistakes are inevitable, but some can be avoided if you know them. Investing can be a daunting prospect. This is especially true for beginners. New investors seem to be up against it. The stakes are high: a stress-free retirement, a new home, and a child's college tuition. Time is minimal, judgment is complex, and getting an infinite number of choices is perplexing. Learning vicariously helps you prevent losses, which means more money in your wallet and a faster path to financial independence. Assume, however, that you are ready to begin investing. How can you go on with assurance? In this video, we go through the most common mistakes made by new investors and, more importantly, how to prevent them. Hello, we're Stock Monster, and we're here to help you identify the top 5 investing blunders based on years of coaching experience, so you don't have to pay the price of direct experience. Please subscribe to the channel and click the notification bell for more videos like this before we continue. When it comes to trading or investing, making mistakes is a normal part of the learning process. Longer-term holdings are joined for investors who trade stocks, exchange-traded funds, and other securities. Traders are more likely to purchase and sell futures and options, retain positions for shorter periods, and engage in more transactions. Even though traders and investors use 2 different trading transactions, they often make the same mistakes. Some errors are more detrimental to the investor, while others are more detrimental to the trader. Both will benefit from remembering and avoiding these common blunders. Investing blunder number 1. Don't invest without a plan. Planning is critical to achieving your objectives and determining what you can realistically accomplish. Income and expenditures, current savings, risk tolerance, period, and insurance requirements are things to consider. Only after you've figured out the whole financial picture should you start planning. Numerous studies indicate that organized enough to write down their investment strategy can expect to outperform their peers by multiples, not just a few percentage points. This is where a financial advisor can help. Speaking with a professional about your financial condition will help you rationally assess your return potential and risk tolerance. Goals can then be prioritized, scaled back, or expanded as required. Finally, having an investment strategy can help you avoid making emotional decisions. When the market falls, panic selling may occur. Investing blunder number 2. Avoid letting your emotions rule. Losses are painful, and they hurt more than the corresponding gains make you feel healthy. Emotion is perhaps the number 1 killer of investment returns. The market is ruled by fear and greed, as the axiom goes. Investing decisions should not be influenced by fear or greed. During more perilous times, extreme loss aversions make sense. If a minor blunder puts one's life in jeopardy, preventing losses is more important than any potential gain. Having an investment strategy would provide a roadmap for dealing with impulses triggered by natural market cycles. In any case, making emotional choices seldom produces positive outcomes, let alone when your money is on the line. The ability to express one's feelings is a source of strength. One of the most valuable qualities you will have is the ability to recognize and control your emotions. Do you agree with me? Please like and share this video with your friends. Investing blunder number 3. Don't try to time the market. There is no handle on a dropping knife. Calling market tops or bottoms is a fool's errand. Attempting to time the market often has a negative impact on returns. Timing the demand correctly is challenging. Even institutional investors also struggle to do so. Specific winners are also challenging to predict. Companies with hugely successful goods aren't always suitable investments. If you've done it, it's not easy to do again. It isn't easy to keep up with. It's no surprise that most stock pickers are unable to outperform the indices. Investing blunder number 4. Diversify, but don't diversify. Assume the portfolio comprises a combination of debt and equity investments spread across various sectors and businesses. Professional investors can produce alpha by investing a few concentrated positions, but average investors should avoid this strategy. It is preferable to adhere to the diversification theory. Diversification is an effective risk management technique when used correctly. Diversification only adds value when the new asset has a different risk profile from the previous ones. However, not all risks can be mitigated by diversification. Inflation exchange and interest rate fluctuations and global instability all pose a systemic risk to business. Risks unique to specific companies, markets, or geographies can be mitigated by diversification. Diversification's meaning is based on non-correlation. Although diversification does not guarantee against losses, assets with lower correlation, such as private credit, gold, real estate, or commodities, are less reactive when the stock market is volatile. Investing blunder number 5. Don't put too much faith in experts. Except for you, everybody has a conflict of interest with your money. So-called investing experts can be found everywhere. The free advice from TV money-mounting banks and message boards full of Buffett wannabes is usually worth it. Touts should be avoided at all costs. Look at how the source's pockets are lined and see how prejudice creeps into your investment advice. Recognize that their vantage point restricts what they can see. We also have biases. You and I are included in this. Many experts are simply advocates for their work. Either they're promoting their book or they're being paid to do so. That doesn't mean their advice is wrong, it just means that they aren't looking out for your best interests. Any investment must be seen in the sense of the overall portfolio. A stock hawked on a message board is unlikely to meet your requirements. This is where a well-thought-out investment strategy and a committed financial advisor will benefit. Only you and your financial advisor are aware of your specific financial position and the best path to your investment objectives. You must be cautious not only with your investment decisions, but also with your sources of financial advice as an investor. Life is short. Learning the art of investing is time-consuming, and investing without a strategy is risky. When you understand how to avoid making some of the most common and costly investment errors, it's a lot easier to appreciate the investment process. It's more fun to make money than it is to lose it. When you first start saving, you should think about what your long-term goals are. Many decisions about your priorities will be needed along the way. You would be better able to reach your investment goals if you stick with your strategy and avoid the mistakes mentioned above. Making mistakes is an inevitable part of the investment process. Knowing what they are, what you're making them, and how to stop them can help your investment success. To avoid making the mistakes mentioned above, make a well-thought-out, structured strategy and stick to it. Set aside some fun money that you are entirely prepared to lose if you ever do something risky. If you follow these instructions, you'll be well on your way to constructing a portfolio that will provide you with several happy returns over time. Please add any investment blunders that I might have missed to the list in the comment section below. This is Stock Monster once more. Please subscribe and switch on your notifications. I'm excited to hear what you have to say, and I'll see you in the following video.